What's going on, guys? My name is Grant Warfield, and I'm a CPA candidate. Today, I'm going to walk through revenue. And I know what you're probably thinking. Grant, I know what revenue is, but if you stick with me, you might learn something new because revenue is more nuanced than you might initially think. Let's get into it. Alrighty, friends, let us get straight to work. So, when I refer to revenue in this context, I'm speaking to it strictly from a GAAP perspective. And if you don't know what GAAP is, it simply stands for Generally Accepted Accounting Principles, okay? And the acronym for GAAP is going to be GAAP. So, if you ever see this, that stands for GAAP in an accounting context. And this is essentially the financial reporting framework used by all public companies. And I know what you might be thinking, Grant, this is too technical. I just want to know what revenue is. But never mind wanting to be an accountant. If you want to be a good capital allocator, right? If you want to be a good investor, you need to have at least a cursory level understanding of generally accepted accounting principles, okay? Because this framework is used by essentially all public companies. So hopefully by now you know the structure of my videos. I always start with a common misconception. I then dispel that myth and then provide you with some formal structure. And that's exactly what I'm going to do today. So, most people think of revenue as money coming in, okay? They tend to think that revenue equals cash received, okay? But under generally accepted accounting principles, revenue is going to equal value earned throughout a given period, okay? So, just to give you a formal definition of what revenue is, and then I'm going to break this down, revenue is going to represent an increase in equity. Okay, and if you recall our beloved accounting equation, and if you haven't heard of this equation, I have another video on said equation if you're interested. But it's simply going to be assets equals liabilities plus equity. This is the universal accounting equation. So, revenue is going to result in an increase in equity. And I'm going to go through the exact mechanics throughout the duration of this video. But to get back to our definition, revenue is going to represent an increase in equity resulting from delivering goods or services to a customer in the ordinary course of business. That's the GAAP definition, we could say. So revenue is only going to be recognized when performance obligations are satisfied. And a performance obligation is simply what you promise to deliver your customer. And when you satisfy your performance obligation, i.e., you deliver your good or service, we consider that earned revenue, okay? Earned and recognizable revenue. But it doesn't have anything to do with the company receiving cash, right? And so the main point that I want to make here is that revenue does not equal cash. These are two different aspects of financial reality. To really drive this point home, I'm going to run through a couple scenarios. The first scenario is considered a cash first scenario. So a customer prepays $1,000 for a 12-month subscription. And so from an accounting perspective, we're going to increase the cash account by debiting it, okay, for $1,000. And we're going to credit an account called deferred revenue. Okay. And deferred revenue, another name for this account is unearned revenue. And we call it unearned because we have not yet satisfied the performance obligation. So this customer has prepaid, meaning they gave us money before we provide our good or service, and we are now obligated to perform for said customer. But as I stated in this scenario, we haven't satisfied our performance obligation yet, so we cannot recognize revenue. And if you happen to be interested, I'm going to briefly walk you through how this revenue is going to be recognized over time. So the total prepayment was for $1,000, and this revenue is going to be earned over the span of a year or 12 months. So we simply take the total prepayment of $1,000 divided by the time over which we're going to earn that revenue or provide our service, which is going to be 12 months. That's going to equal approximately $83. And so each month, we're going to debit deferred revenue, meaning we're going to reduce that account balance and we're going to recognize revenue because we have provided our service, we have satisfied our performance obligation for that period. Okay, so just remember that cash does not equal revenue until the service has been delivered. Now let us go through one other scenario to really drive this point home. This is going to be a revenue first scenario. So in this scenario, we did some consulting work. We completed that work. The invoice was sent, payments due in 30 days. So in this scenario, because we completed our work, i.e., we satisfied our performance obligation, we could recognize revenue. So in this scenario, we don't have to worry about any deferrals or anything of that nature. We're simply going to debit an account called accounts receivable. Okay? The acronym for this is AR. An accounts receivable is considered an asset, meaning it's a probable future economic benefit. So we expect to receive payment from our customer, but we haven't received it. But since we have satisfied our performance obligation, we could recognize revenue. So in this scenario, cash is going to come later down the road. Revenue is recognized first. As you can see, revenue recognition is not too bad. Once you get into it, it's pretty intuitive. So as I go into the last section of this video, I want to map this concept onto the accounting equation as a whole. So again, we have our beloved equation, okay? Assets is going to equal liabilities plus equity. Total resources is going to equal total claims on those resources, right? That must always balance. So revenue is going to represent an increase in equity, and I'm going to show you exactly how that works. So we have revenue, right? We have created value for our customer. We have satisfied a performance obligation. Revenue, part of that revenue, after expenses are deducted, right? Revenue minus expense is going to get us net income. Okay, so we have net income over here. Net income minus any distributions to owners. Okay, so a portion of earnings, if the company decides to distribute dividends, is going to be distributed back to shareholders. Okay, so net income minus dividends is going to get us retained earnings. Retained earnings right here. Retained earnings is a component of equity. Okay, it's a component of this portion of our equation. And so all we have to do to understand this is follow the logical flow. So we have revenue. A portion of that revenue gets converted into net income. We take out dividends. That gets us retained earnings. And because retained earnings is a component of equity, equity is going to increase. So the main takeaway that I wanted to provide you with today is the fact that when you're reading an income statement from a public company, you have to know that revenue is going to follow the delivery of value, not the movement of cash. Okay, these are two different aspects of financial reality. Cash is going to be a measure of liquidity, meaning can we satisfy our present obligations, our short-term obligations? And revenue is more concerned with economic performance. Okay, throughout this period, how did the operations of this business perform? Alrighty, guys, thank you so much for watching. I really appreciate your time. Please let me know what you think in the comments. Like, subscribe, stay tuned. Thanks.